Well, today is Monday, January 24th. It is just after the market closed. It was a wild session today, and we think we have a pretty unique view on the flows over the last couple of days, and so we want to touch on that in a very quick video. So first, we want you to notice a couple of things. There was obviously this huge drawdown today. We pulled down over 4% at the bottom, and then we had this massive 4% rally back to actually close in the green, something a lot of people probably didn't feel like was going to happen this morning. And so we wanted to touch on, again, what were some of the drivers of this round trip move. So first, you're going to notice OPEX was on Friday. Now, for those of you who are new to this concept of options expiration and or why this may have been an important expiration, we suggest that you pause this. You can go over to spotgamma.com, and that link sends you over to this article, which talks all about this massive options expiration that we had last week. We discussed not only in video format, but also written some pretty in-depth analysis of why these flows may have been important and why they may have led to this volatility, not just last week, but also in today. And you can also flip over to Bloomberg. We'll link to this article as well. They were kind enough to cite some of our work on Friday, discussing, again, some of these OPEX dynamics, not just from SpotGamma, but also a bunch of the major banks are quoted in here as well, like Goldman and JP Morgan. So that'll give you the background on the options expiration that led to today's high volatility. So for those of you who are familiar with the options expiration, we know that we had something what we call the options expiration hangover. So if you look at major drawdowns in the past, most notably December of 2018 and March of 2020, those lows, the lows in the market after major market crashes occur the day after options expiration. So this is a little bit different in that it's a January options expiration, but there were a ton of put options expiring on Friday. And we think that what happens is there's a lot of hedging adjustment, and those flows exacerbate volatility on the Monday after the Friday expiration. So we have this negative gamma feedback loop. We have a lot of hedges coming off from expiration. And when you have this negative gamma feedback loop, as the market goes lower, market makers and dealers who are short put options need to continuously sell futures to hedge. And we think that is a major driver of why the market slid down so sharply. Now, conversely, if we start a rally, the dealers need to buy those futures back. It's a two-way street, that negative gamma position. So the big question for today is not so much why did we get so much volatility? It was a lot. But what exactly happened here that flipped the script? Now, there's a couple things here. One, Europe closes right around noon. So a lot of times there's those morning flows that will expire or change sort of around 11:30 or 12 o'clock. But the other thing that we wanted to note comes from a new tool we call the hero indicator. Now, on this chart here, you can see there's a series of lines, and we'll quickly walk you through these lines. Note that here's this price of the spider. So this is the spiders we're looking at. The black line here is the price of SPY. And as you can see, there's a significant drawdown in this bottoming that we highlighted on the last chart. Now, there are two additional lines, and the blue line and orange line, they are tied to the second axis here on the right. And what these are the options deltas that have traded today. Okay, so we have the put options deltas in blue and the call options deltas in orange. And what you can notice here is that as the market draws down, we had negative delta trades in puts. That means people are buying put options to start the day. And then all of a sudden you can see right around 12 o'clock, a huge put seller comes into the market. Again, somebody came in at the bottom here, they sold puts. Now, I would argue that this triggered suddenly a short cover rally in the market. As you can see, these deltas in put options continued to be positive for the bulk of the day. So that is telling us that people were scrambling to cover their long put hedges. Now, as these people buy back put hedges, dealers and market makers who are short puts can buy back futures. And not only that, you end up getting an implied volatility crush, which further pressures the price of puts, the values of puts, which means you can kick off this reflexive negative gamma feedback loop of dealers buying back short hedges, and we get this big rally. And it's hard to dispute the fact that these puts all started getting closed before the big rally in markets. And now if we switch over to the VIX, you'll see a pretty similar situation in terms of the timing. I mean, it's very interesting to us, and you can see again, here's the VIX, that we were getting these highs. This is as the market was bottoming in here, but you can see how sharp this drop in the VIX is. And the VIX is a function of the value of S&P options that are less than 30 days to expiration. And so if options start to get sold, if puts start to get sold and the market starts to rally, send the value of options as a whole down. It's also something of a signal of demand, right? If this is dropping, it's telling us that put options in particular are losing value in this case, That peak in VIX coincides very much with the SPY options deltas being sold. We also saw obviously some calls being purchased, and that led to this very substantial rally in markets. Now, we don't think that implied volatility will come down all that much more because of Wednesday's FOMC, and we would like you all to highlight Thursday night at 4:30 p.m. That's this upcoming Thursday. We are going to be on with Darius Dale from Macro 42 to discuss the outcome of the Fed and how we see all of these short-term options flows impacting the market. So I hope this video is helpful. If you have any questions, please leave them in the comment section below or send us an email at info@spotgamma.com. Thanks.